Welcome to the Fifth Piece channel, and I am not a financial advisor. Please do your own due diligence before investing. Canadian cannabis sales are continuing to balloon amidst the coronavirus pandemic. The latest data from Statistics Canada show that in June, retail sales topped $201 million and were up 8% from May's total sales. And during the second quarter, which ended June 30th, revenue from the nationwide legal market finally finished ahead of the black market. That's the first time that the market has come out on top since the Canadian government legalized marijuana in October 2018. The Canadian pot market is showing more promises than ever before, and two popular cannabis companies stand to benefit. Despite their historic difficulties in generating cash, paying off debts, and avoiding massive write-downs, Aphria and Aurora Cannabis could be poised to claim shares of the rapidly expanding marketplace. Today, we will look at which stock is the better positioned pick. Aurora will release its results for the fourth quarter ended June 30th, and it will be a pivotal moment for the company. Aurora has struggled in previous periods to grow its revenues and stay out of the red. Convincing investors to buy up this struggling stock, which is down more than 70% this year, will require the company to post stronger numbers ahead of a new fiscal year. Unfortunately, all signs point to this being another underwhelming quarter. In a September 8th update, Aurora announced that it expects Q4 net revenue to come in between $70 million and $72, well below Q3 numbers. And if that wasn't bad enough, it will record an impairment charge of up to $1.8 billion on goodwill. Given all this negativity and the challenges ahead for Aurora in terms of both sales growth and profitability, it may not be surprising that Michael Singer is delighted to now be transitioning the CEO responsibilities to the company's new CEO, Miguel Martin. Unless Aurora is purposely setting the bar low for the upcoming quarter, it looks like it'll be another disappointing period for the Canadian pot producer. Aphria is coming off a tough quarter of its own, yet it remains more consistent than Aurora, and has been less of a disappointment to investors overall. In 3 of the last 5 quarters, Aphria has finished in the black, achieving positive earnings and profitability. Aurora has turned a profit just once in its past 5 quarters, which only happened because external income gave its bottom line a boost. One of the strengths of Aphria's business is its diversified distribution structure. In its most recent fiscal year, $369 million of its $543 million in net revenue came from distribution revenue. Most can be attributed to CC Pharma, a German importer and distributor acquired in 2019. The acquisition of CC Pharma allowed Aphria to stand its products on a pre-established platform across over 13,000 pharmacies in Germany. The deal will also help the company penetrate the broader European market for cannabis in the future. Aphria is the better buy, by a mile. Although Aphria comes with its own question marks, there isn't much of competition between it and Aurora. Aphria is indeed coming off a bad quarter, but poor performances just aren't as common for the company as they are for Aurora. Investors are more likely to get burned by Aurora, which has fallen short of its estimates in the past and is already pushing back projections for adjusted earnings before interest, taxes, and profitability. The pot company has a lot to prove. That's why it's no surprise that year-to-date, Aphria's stock has dwarfed Aurora's, and it's not far behind the horizons.